What up, everybody? I hope everybody's doing well. My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. Okay, so I thought in this video what I would do is just give you step-by-step protocols or instructions on how I handle a bear market. You have to move fast. You cannot hesitate. If you were to hesitate and hold through this, then you're going to be that guy saying you can never time the market. Time in the market is better. Yeah, that comes from people that hold in here and take damage and have to wait. There is a way to get out, and if you were watching my videos, I was telling you weeks before to get out a margin. I was literally instructing everybody on exactly what to do, that this was going to happen, and then boom, it happened, kept happening, and kept happening. Now, I'm going to, instead of putting it in multiple videos, I'm going to walk you through the steps and the reasons why you do each one of them and how to do them in what order. And this is really a defensive play. It's not an offensive play. It's a defensive play with a mixed hybrid of hedging for a smooth ROE, which is return on equity. So I'll show you how to do that as well, okay? Let's take a look at the indexes and see what is going on. Okay, so, if you've been in the market last few days, kind of been a little bit flat. It's up, it's down, it's up, it's down. It's ending just a little down or a little up. It's kind of flat going sideways, which, feels a little bit better than just a straight drop to the bottom of the pool, right? So that's good. However, this particular market is sentiment driven. It's based on a lot of fear and uncertainty. And until we truly get a catalyst that is going to revitalize this market, it will most likely be quite lackluster. In fact, when it does find a bottom, which is not showing that it has by any means, it might actually grind and scrape for a little while around the bottom before it finally starts to get enough steam and momentum back. I mean, if you look historically, a lot of big declines in bear markets did go from the 30, 37, 29 to 37, kind of historically. So that could happen, and then it bounces back. But remember, we don't have the Fed to help us. We only have the Fed to hurt us. The Fed wants to pull liquidity out of the market. They want to crash the market. In fact, they already have. And now they're coming for the real estate market. We could talk more on real estate later. All right, so look, this is the Dow. It's currently down 14.4% from the peak. Now, remember, the Dow is a barometer for the economy. If the economy is thriving and everything is moving on all cylinders, it'll show up as a bull run. That's how it works. If there's problems with the economy, GDP, supply chains, import, export, labor market, anything that pertains to how well the economy is running, then that will show up in the Dow. And that's why I show you the Dow a lot. It's a leading indicator. It will lead us down into a recession. Usually it goes all the other indexes, the small caps, and then the NASDAQ, and then the SPY, and then the Dow. And when the Dow breaks, which it's getting pretty close to breaking, that's when you pretty much are already, signaling recession. And next comes the housing market, then the credit market, then the foreclosures, the bankruptcies, the layoffs, or actually the layoffs, foreclosures, then bankruptcies. It would go in that order. And then the Dow will actually lead you out of it. So before you're out of a recession and everybody's found a new job and gone back to school or whatever happens, the Dow will be leading us out, okay? It's a leading indicator. So the Dow being down 14.4%, it's a lot. We can feel it. It's not the furthest it's ever been down, but it's definitely going down pretty significant with the lower highs. Again, lower highs, and then just a steepening drop again. Red cloud, red HMA, under the 200, red ribbon. I'll put the ribbons on for us. Everything is bearish on it, as well as the other indexes as well. So yeah, if you had any of the 30 stocks that were in the Dow, and it's easier to explain the Dow because if I talk about the SPY, we have 500 different ones, and the NASDAQ, you know, I don't even know how many, there's a lot. So if you understand the stock that you have and what index it's under, is it a small cap and it qualifies under the Russell? Is it a SPY, top 500 US companies? Is it top most influential 30 companies and it's in the Dow? Is it a tech and growth company? It's in the NASDAQ. Which part of the NASDAQ? You want to understand this stuff, okay? Then what you want to do is you want to be able to identify, even in the most simplest ways, even if you don't need to know volume and all that stuff, but what you do need to understand is at a minimum you can use the MACD. And when the MACD crosses over, the blue crosses down here, you're in trouble, okay? So like, let's go look over in this area and see what happened. See right there how it crossed? That's trouble. And it would have got you out right here, and you would have stayed out until right here, which means you would have caught this little rally, and then it told you to get right back out, and it told you that you can get in right here, and if you would have done that, you would have caught this whole rally, and then it told you to get out right there. And so the MACD is a very simple way. It's not the best way by any means, but it is definitely a good, like, beginner's just rule of thumb. The MACD is very good. I prefer volume and lower highs and you know, more chart patterns and just, you know, feeling it out. But I mean, the indicators are really, really good, and a combination of them never hurts. So the first thing that you do is you need to identify the tops, like I was telling you guys back in September, and then again in November, and through December, January, and through the whole thing. I was explaining back before all this happened that it was coming and why I saw it coming. So when you make that new primary trend and then you don't advance high enough to make an all-time new high or break the previous high to make a higher high, you start making a lower high, and then when you reject and you confirm it, you make that primary trend, which is a downtrend, okay? And so you want to pay attention to your indexes, and this is all part of number one, okay? So you want to understand your indexes. Even if you're not in the market, you should be looking at the indexes every day because it's a barometer for the economy. It'll tell you if you're going to get laid off in 6 months. I mean, you can tell a lot from the Dow, okay? The Dow really, really, really is a powerful index to watch. So just know your indexes and know the stocks that you have if they're under them. If that MACD crosses over, you need to take a hard look at the stocks that you have under that index. Let's say you had Visa, Microsoft, and Apple, and this was crossing on the index right here on the Dow, and those three stocks are in the Dow. You would then go to your stock and see what's going on with that, if it's going to come down. Now, remember, to make a lot of money, people that usually don't have a lot of money, that want to make a lot of money, will put their money in small cap and NASDAQ because it's high accelerated growth. Plus, it's the funnest. It's super fun to trade in there. However, what goes up can come down just as fast, right? Whereas wealthy people, they like to put a lot of their money in safe, secure mutual funds, maybe a mix of international and domestic, as well as bonds, and then Dow stocks, okay? Why is that? That is because these are 30 of the most influential companies. They are not going bankrupt. They've been around for a long, long time. They employ a large amount of people, and they're very stable, okay? So it's a good place. And if you notice, the NASDAQ is down close to 30%. We'll look in a minute. I think it's around 30%, maybe a little less. But the Dow is down half of that. And that's kind of what I'm talking about. So rule number one, you identify on the index, and then you look at the stock within, and you can save yourself a ton of damage right there, okay? Now, I'll go through the indexes here while I'm talking about this. So next, let's go look at the NASDAQ. So the NASDAQ, I gotta adjust all this. Okay, the NASDAQ is down 30.32%. Lower highs, definitely damaging. I mean, let's go look at our MACD here. Okay, it said you could buy right here, and it said that you should be selling. I don't like to sell until it crosses and you can see a black space, so that would be right there. And if you look up the chart, you would have caught this entire run, and then you would have got out and you would have skipped all this. You would have skipped all of it. Okay, so the MACD is very simple. It also works really good on Bitcoin on the daily or the weekly. It works really good. In fact, there was a study done where two guys, one invested and just held, and then one traded the MACD and ended up with millions of dollars more by just trading in and out on the MACD in the same amount of time with the same amount of money from the same day. It's quite impressive. It's kind of cool. So yeah, the MACD is really good for Bitcoin. Well, all indexes. It's good for indexes, really. And, you know, let's just take another look. It says that you could get in right here and you can see that you were going up, but what it is it needs to have an angle and it needs to have a black space, and the bigger the space, the more conviction, more money, and more volume and more upward pressure it's going to have. So the direction is really important. Like for instance, right here, see how it just launched up and there's a big space and the histogram's rounded? Well, right there, if I look up the chart, it looks like it's running, and it says get out right there. Wait, sorry, right there. So yeah, you would have caught this whole one. So it basically got you in here, it got you out, okay, and then it got you in here and got you out, okay. Now, if you're a little bit more technical and you like shorting or doing, you know, short-term puts or whatever, you can also just run it backwards. So if the purple line is going above, that's a good time to go short, okay? And then when it crosses back, then you cover your short. So you would have got you in this whole thing, and you would have covered right there. So the MACD is really good. Just understanding your indexes, having identifiers, knowing what goes under the indexes and what's in your portfolio. This is how you avoid taking a lot of damage on the chin and going through all this pain and not knowing when it's going to end, and just you know, a lot of pain can be in here. Okay, this is every 1% on an index can be multiple percent on your stock. So just food for thought. Okay, so that's number one. Okay, number two, when that happens, the very first thing that you do is you exit all your profitable positions. Okay. Now, there's a lot of schools of thought on this, and what I'm talking about is going into a bear run, okay? I'm not going to walk you through every single thing with bubbling volume and topping patterns and all that stuff. I'm going to just assume right now that you know that. If you don't, I have a Discord link, and it's in my courses, and I'd be more than happy to help you with that. And you can see how I was able to spot that way back in here. Way back in here, and then over in here, and just, you know, kind of got us out and traded up and down this whole way. Okay, so you know, you might want to hold in these declines when you're going up in a bull run, but I'm just assuming we're in a bear run. How to spot it and what you do immediately without hesitation. You can use the MACD, and you go look at your few that are under that index. You see the health of them. Usually if the index is coming down, your stocks are going to come down. That's just rule of thumb, okay? Number two, you exit all of your trades or positions that are profitable, which you should have a lot of profitable because you're coming out of a bull run, right? Okay? And just about everything goes up in a bull run, but the ones that go up a lot will be leaders, and they'll have great fundamentals and services, products, good CEO, things of that nature. Okay, they'll be growing and accelerating their earnings and revenues and whatnot. Okay, but when you're in a bear, you identify on the index, you check on your stocks, you pretty much just know, okay, well, my stocks are going to come down if the index is coming down, and you exit all those and you take your profit. You realize the gains. Okay, you don't want to go through a whole bull run, make all this profit, and then realize the gains at the bottom, or take a loss at the bottom. You don't want to do that. You want to identify and make a move to capture those gains and realize the gains, okay? So that's step two, okay? Now, you do that because you want to realize the gains and you want to protect your capital, okay? You want You're building wealth. That's why you're in the markets, and you want to. And capital protection and risk management are very, very important. Now, a really good way to just do all this is just simply set like a trailing stop using an ATR, a range, a percentage, whatever it is you like, or using classic stops as well is wonderful. I use classic stops a lot. So you can do that, and then, as a fail safe, if you bought down here, you come up here and you got your stop and you just move your stop, move your stop, move your stop. You just keep doing that, and then one day when it comes down, it'll stop you out and you'll capture all this profit. That's really like the best way. But if you didn't have that, which you should, but if you didn't, you're identifying it, and you're knowing that everything under the indexes will come down if the indexes go down. So you're on high alert, right? You might as well take your profits, protect your capital, and let's move on to number 3. You got to have a plan to de-risk and get out of margin immediately and completely, not part of the way, all the way. So that's why you shouldn't be 100% invested when things are getting shaky. Like when this one happened, maybe you hit this, but it's always good to trim it out into strength. And then when it says sell, if you're selling all those ones in the profit, your margin, it's going to go back to your margin, and you're not going to owe if something comes down. So then you're kind of safe. But let's say you didn't get all of them out and you still had some margin, okay? Well, you got to have a plan for that. And what I do is I'm also good at trading, okay? And this is something that I'm going to say is a trading technique, okay? It is not recommended or suggested for somebody that does not know technicals, that is not good at trading and understanding like pivots and momentum and how to spot this kind of stuff and kind of flow with the markets, okay? This is definitely adds a level of risk. It's a high risk maneuver, but if done right, it's incredibly successful at getting all your money out without the loss. And so what you do is, let's say you got most of them out, you're still in some margin, you go down and you're like, oh my God, I'm gonna get margin called. Well, the next time there's a pivot right here, there's gonna be a few in your portfolio that are green and gonna be going back up for the rally. Okay, whatever the least loss percentage is on that, let's just say it's 10%. You're gonna load the boat. That's why you sold and you have all those realized gains. You still have margin, you still have money, cash on the side, even if it's a cash account. You're gonna bang it out on that pivot. Okay, you're gonna run it up. Let's say it's a charge point as an example, and charge point came down to, I know it's really low right now. I saw it. It's low. It's like $7 or $10. It's really low. But let's say back here it was like, $15. Okay, and from here to here was like 15 to 18. Well, let's say you're down. Okay, you bought it at 18, and it's at 15, and you see that the index is coming up. You have a bullish pivot. Okay, and what you do is you see on your Bloomberg and you see on your indexes and you see everything that you track your indexes on going up. What you do is you go down to your I like to be on the hourly, just so you know. Let's see if I can find you something that looks. Well, I think DraftKings had a decent day. I wouldn't quite say that's bullish to the hourly, but basically what you want is you want this thing to curl, which it did. You want it to be heading up with price action, and it's best if it's a blue ribbon, it's above the 200. That would be like strength, because you're not fighting the red tide, which is an overall downtrend. Okay, you got to pay attention to these overall downtrends when you're a trader. You can trade in and out on the minutes and the hour, even in a downtrend, and go long, but you have to have conditions to exit on the minutes or the hour. That's for another video, or the courses. That's a little bit more technical. Always best to kind of go with the overall trend. But right now we're in defense mode, okay? We need to get charge point out. We're down $3 on it. We have 5,000 shares, okay? That's $15,000. We're backwards. We don't know where this market's going. It's showing signs we could be going down further, possibly even into a bear market. The media is starting to talk about all this crazy stuff. Inflation's coming out. Biden's spending money everywhere except here. There's talks of the real estate, bubble. There's all kinds of problems, right? So you're a little nervous. You're down 15 grand, and you see this bullish pivot. Well, if you get some strength on the hourly, which will happen pretty quick on one big green day, you'll check that out, and then you'll come to the minutes, and you'll have your conditions. And when it goes blue right there and it goes above the 200, you load it up. So let's say you were down, bought at 18 and you're down $3, so you're down like 16%, okay? So 16%. So if you double your position, you buy another 5,000 shares. I know it sounds crazy and it's risky, but this is how you're going to get your money out without a loss, okay? You have to do it into a bullish pivot. You have to do it into a pivot. If you don't do it into momentum, you're going to lose more money. That's why it's risky. You're adding more shares, which is utilized to get you out. So as you're lowering your percentage, you're adding more shares into momentum. It has to be into momentum, because the more shares you're gonna have, instead of 16% loss, you might have a 1% loss, but the same dollar amount, 15 grand. Okay, now you're gonna have more shares. There's the more risk. But because you're doing it technically into momentum, those shares and that momentum are going to bring that dollar amount to zero, and your percentage loss to zero, and even probably a gain, because you're not going to exit without a condition. Maybe your condition is when this goes red, okay, you get out. Maybe your condition is to wait till the ribbon goes. Maybe your condition is just stay in above the 200. Whatever it is, you're on the minutes, okay? So it's going to be kind of small in comparison. The main thing is that the indexes have to be going up and your stock has to be showing bullish momentum to do this maneuver. So you go after the lowest loss percentage first. The reason you do that is because the ones that are down there that are 20, 30, 40, whatever percent, hopefully you don't have those, but let's just say you do, they're gonna need some more medical attention, which means you're gonna need to like raise cash. And it's easier to get your small ones out first because you use less cash, meaning you have less risk when you do this momentum play, okay? This should only take you 30 minutes maximum. You should only be in for 30 minutes maximum, okay? If it's a crazy, crazy bullish pivot, run it up into the profit, take your little 0.5%, 1%, 2, 3, whatever. I don't know how bullish the day will be. You'll know by the indexes and you'll know by the technicals, okay? But really, if the whole plan is to de-risk because you think you're going down because all this fear and all this uncertainty is happening, the goal is not to, get in there and stay in there and think it's going to go up again tomorrow. The goal is to put the money in, put the risk into momentum, get out at even or just a little bit above, and then de-risk and put it to the side and stay out of margin. Okay. The way the markets go is they ebb and flow, okay? They ebb and flow. So every day it's going to go up and down and up and down. If it's a bullish day, it's going to go up and down a little and then up more and then down a little. It's going to trend up. If it's a down day, it's going to go down and up a little and down more and up a little. It's going to trend down. They all ebb and flow. There's always places to work it. But if you are trying to do this bullish pivot into momentum to de-risk, you have to do it on an up day where it's trending up. So you identify that. You don't buy for the first 30 minutes in the morning. You have to wait, and you got to let a few of these ebb and flows happen, okay? You don't want to get in the middle of a condition. You want to get in at the beginning, and you want to get out as you plan, okay? You have to be in and out. These things take me 1, 2, 3 minutes normally, up to 30 minutes maximum. You're in, you're out. The plan is to de-risk and stay out of margin, because when the slope gets slippery, everything can fall pretty quick, right? Okay, so you start with your lowest percentage. You're in, you're out, you de-risk, okay? Remember, a lot of that money is your profitable gains that you already de-risked as well. You work down the list in order, okay? From smallest percentage, same thing, rinse and repeat. You gotta wait. Maybe it's the same day. Maybe you can get 3 out in one day if it's bullish enough, but don't count on it being bullish the next day. In fact, this year, 2022, there has not really been 2 big green days in a row the entire year, and we've been trending down for over 6 months. So don't count on that. Just count on uncertainty and count on it going down and count on your plan to get out. And a lot of times you have to wait for this momentum day. Okay, you can't force it. You have to listen to the market, and you got to work with the market. You cannot force this play, otherwise you could end up losing more money. Okay, it is risky, but if done right, you can get your money out really, really good. And even if you catch the bullish momentum and you go up $1, $1.50, $1.75, $2.10, but you were down 3, and then it turns on you, hey, you're only down 90 cents. Okay, that's not nearly as bad. You just went from a $15,000 loss to a $4,500 loss. Okay, imagine as it's going down, if your account's big and you're losing fast, if you can mitigate that down and just take a smaller loss in a declining market, that is better. Okay, reason being is because you've identified that we're going into a bear, and you know that historically bears can last 6 months all the way to 2 years long before the 6-month bottoming process. And then they can actually be as long as 18, 20 years just to get back to the like where it fell from. Sometimes they do that, okay? So identifying them and having a plan to get out and doing it in this process into momentum, and then going down the list from smallest percentage first, because you're gonna need more money to get the heavy ones out later. Plus, if they're down that bad, what I've realized is if they're down that bad, they're not going to be coming up first anyways. Those are going to be like your Unities and there's a whole bunch of them out there. Okay, Affirms, whatever, SoFis. Okay, they're going to be wrecked anyways. So you're going to need money for that. Might as well work on the little ones first, because those ones aren't getting done hammered. And it's always best to not only do it in a momentum on a bullish day, but also, when they're super oversold and the market is kind of like, okay, we're gonna pop this one up 14% today on DraftKings. That you find the momentum and you find that day at the same time, and you just muscle down with the money and you get out and you take a 40% loss down to a 5% loss into momentum, and you get out with a 1% loss, or maybe you get out with a 1% gain. Either way, you've mitigated risk or you've made some money and you've done it smart. Okay, next, it kind of goes with number 4. It's reducing positions and consolidating. Okay, remind you, this is not for dips this is not for things like this. Okay, this is not when you're in a bull run and your ribbons are blue and you're having dips. Okay, you can hold through that. That's okay. That's you're in an uptrend. I'm talking about when you're in the bear, when you're coming down. Okay, these are mitigating tactics. All right, so if you had 20 positions, you immediately sell in the profit. You have less positions, right? You have some that are down. You're waiting on the bullish momentum. Anytime there's a bear, there's going to be big knee-jerk momentum hits to the upside pretty quick until people get totally depressed and this thing happens, where there's no money wants to go in. Eventually, it just the way these things end is a couple ways. Number 1, there's just no buyers left. Number 2, there's just nobody left to sell, so it's not going down. But by the time you get to that point, usually there's all kinds of economic turmoil. Okay, there's bankruptcy courts are full, suicide rates are up, and foreclosures are going on, and people are being laid off, and it's just a shit show out there by the time it gets to that point. But what I'm trying to show you is how to deal with this and protect your wealth before all that stuff happens and not be stuck in that scenario. Okay, so you sell in the profit, you de-risk into momentum, and it's still dropping, so it's pulling on your margin, because you always want to be the one that decides on what to sell, not ever be a margin call. I've personally never had a margin call where they have sold stuff from my account. I have gotten an email once that said margin call day 1. That was enough to scare me. But I'm a finance guy. I don't like that kind of stuff. So I think in terms of risk. I think in terms of liabilities. I think in terms of probabilities. And yeah, so it's just like, I think in like two columns, liabilities and assets, and that's just from owning a lot of businesses and just being a financial guy. Yeah, the SPY, we're on the SPY. This is down 18.79. This is pretty bad, guys. A lot of momentum coming down. Red ribbons, red HMA under the 200. Doesn't look like it is ending soon on this. God, that volume is increasing with the deep direction. Not good. Look at this. Oh, the reverse caliper. That's showing this. Oh my God, look how slow and steady the MACD is drawing down. Yeah, this thing is not, we're not bottoming. I see there's some stuff up in after hours. In fact, I pulled it up. Of course, I watch this stuff all day. Coinbase, Silvergate Capital, CCJ charge points in there. Piedmont Lithium, Pubmatic, Plug, some of the ARCs, some of the crypto ones like Hut Mining and Netflix, DraftKings, Dutch Bros, SoFi, Nvidia, Mara. So it appears that it's going to be a better day tomorrow, and we did have, or today on Friday, and we did have a rally towards the end on Thursday. But really, if you look at the charts, it went up and down and up and down, and that rally only got us a tiny little smidge from where we opened. Okay, so if it is up in the after hours and you're seeing this on the overall downtrend, you're not at a bottom. You're still buying the dip if you're adding shares right now. You don't want to do that. You just want to buy one time. Just save your money and wait for your stock. Let's call it DraftKings. You go to the daily and you say, okay, I am not, let's say you're down 50% on DraftKings. I know this thing went down 300%, so some people probably are. And let's just say you want to average down. You want to basically get a better price. That's okay. You just wait and wait and wait and wait and wait till whatever happens in the world, in the market, and you wait until this blue line shows up, or your ribbon, or whatever your condition is. I teach you guys about all these indicators, and you get all the coding and settings and stuff. But this thing is red and coming down, so it would have to finally find its bottom and then go blue before you can actually do that, and you could cut your losses. Okay. Same thing if you're dealing with the indexes. Are the indexes showing blue yet on the HMA? No. In fact, it just went red again. That means it's probably going to get nasty, guys. Look at the direction of the cloud. Look at the direction of the ribbon. Look how fast we're falling from the 200. Quite frankly, this is how I'm making money. As the indexes are going down, I'm making money. Okay, check this out. Okay, so those are all inverse and like hedge type plays that I put in there. That was a $41,000 day. There was a $44,000 day. So as all this turmoil is going down, those ones are going up. I'm betting against the healthcare sector, betting against the semiconductor sector. I'm betting against, I shorted some of the crypto stocks. Everything is directional with me. We're going in this direction, so I'm going in that direction with it. I don't fight the tide, and I'm not fighting the Fed, okay? I'm not doing that. I did that before. It doesn't work out. At least it didn't for me. Didn't work out too good at all. So I'm not fighting the system. I'm not fighting the tide. I'm not fighting the trend, and I'm not fighting the Fed, okay? I'm going in the direction of it. And if I had longs, which I do have some, I've reduced a ton. I actually am only down to like 4 longs, which is like not that crazy. And I'm not buying those until they get bullish on the daily, okay? And they're deep and they're a loss and stuff, but I'm profitable now because I've reduced so many of the longs and in a downtrend. Otherwise, you would have to overload up on your hedges, which I can walk you through some of them here shortly. So as you're de-risking, you're reducing risk, and you're getting ready to concentrate or consolidate your positions. You're going to have less positions, and you're going to be doing that springboard effect where you have more shares and you get out. You're You're trying to pull your longs out. Okay, that's what you're trying to do. Unless you're like going cycle to cycle, but that's I would never recommend not selling at the top and not buying at the bottom. I just think that's like the way to do it. Hard to talk me out of that one. So yeah, you need to decide prior if you're trying to eliminate the position or hold the loss until strength later. So like I was saying with DraftKings, are you going to hold it and let it go down 100% and then buy when it gets bullish at the bottom? And you'll know when the bottom is. You'll know. It's going to be a whole different vibe on YouTube, a whole different vibe on TV. There's going to be news everywhere. Like it'll be all over Facebook and Reddit. You'll know. And that's not happening yet, so we're not there. So you need to make a decision up here if you're going to hold that Apple or Microsoft or whatever it is that you love, AMC, DraftKings, whatever. You got to decide if you're going to hold it or if you're going to springboard out on momentum and reduce risk and then try to buy it at a lower price later when it bottoms. You got to make that decision. My thing is always getting to cash and getting to at least 80% cash. So, well, 70% cash, I think is more realistic. Try to get to 70% cash. It's very hard when every day is going down and you have margins. So you have to be extremely tactical and you cannot hesitate. You have to have a plan. And a market like this can really mess with your psychology. It can mess with your health and psychology. You can be arguing with your family. It could be not nice to your children. You could just be grumpy altogether. I mean, it sucks to watch your money go down, but you don't have to. If you learn how to identify topping patterns and use that MACD like I was showing you, that could really help, okay? So you're trying to reduce positions and get more to cash, okay? The goal is about 70% or more. We already went through number 6. Do not ever average down or buy any more shares of a position you want to hold until it fires a buy signal on the daily, okay? That means, for me, a buy signal is when this red one turns into the blue. And it has to be the middle. You can't buy it when it's going down against the price. You have to buy it when it goes to the middle, okay? And then it'll hold through, and you know, that's kind of how it goes. And if you look at, I mean, I look at a lot of different things, but it says it gets you out right there for this nasty dip, and then it buys you right back in there. It catches the whole thing, and it gets you right out there. You're not in, and it gets you in right here. Catch this whole thing right here. Catch it all. So, yeah, I mean, see, there's the middle. It's safe, and it gets you in, and it gets you out right there. And you skip all this, it gets you in, it gets you out right there. So if it becomes bullish to the daily, then that is where you would buy. But you don't buy the dip and average down, because what you're doing is you're adding more shares, which adds more pressure while it's coming down, which means you're just wasting your money, and you're just giving yourself more stress. Because when you add more shares and you think you're getting a lower percentage, well, that percentage just drops on you because you haven't found the bottom yet. So you want to always, when you're going to hold a position and average down, you want to wait for a bullish pivot or a bottoming process. Because the goal is that the price is going up when you average down. So you're cutting your percentage and you have the momentum bringing you up quick. That's how you do it. You don't go down and then buy more and go down faster and faster and faster and faster until you explode, either mentally or financially. So yeah, definitely that's something that I know is out there on YouTube. A lot of people are telling everybody the wrong way to do that, and this is very important. This is how you can be successful, or you can destroy your entire investing and trading career by doing that, buy the dip, average down in a downtrend. You don't ever want to do that. In fact, another big misconception is dollar cost averaging. You're supposed to dollar cost average in every single time in the market except this time. See, this gets overlooked, except for college professors or pros or whatever. They know. But you don't dollar cost average in a bear market. You wait for the bottoms, and then you scale into strength. You can dollar cost average all the way up in a bull. You can do it. You can nibble every Monday, every Wednesday, whatever it is you like, once a month. That's great. And like I said, out of all the markets, dollar cost averaging is wonderful every single time except one time, and it's this time. This is the one time that you don't do it. I have a whole book on this. I've read it twice. I know all about this, and the guy is right. He is correct. You don't do it because it adds more shares, which adds more pressure to the downside, and you certainly couldn't have a margin account doing that. You would get wrecked fast. You got to wait for these things. You got to just, if you decide to hold, you just got to let it do its thing and then wait for it to get your condition and then buy here and just load the boat on it. That's why you need a lot of cash, because if you got a lot of positions, you can't load the boat and do the springboard effect unless you have like a ton of money. Because if you hold them all and they all go down 60%, it's going to take a lot of money on every single position to buy it out of momentum off a bottom. So what you got to do is you got to reduce those positions. You got to take the gains early. You got to springboard out of the small ones. You got to raise cash. Basically, you got to raise cash. You got to go down the line. You have to consolidate the portfolio into less longs, and then it gets to our next one, which is hedging. Okay, now I'm really good at hedging. Hedging is a very, very powerful tool. What you do is, let's say every day you're going down like 10 grand or 20, 30 grand, whatever. You have to take that money and you have to go in the direction of the other ones. I always prefer to go in the direction of sectors when I hedge. So what I do is I buy SQQQ. That means short the NASDAQ. So if the NASDAQ is coming down, I'm making money. So that one's going up as my longs are going down that are in the NASDAQ, okay? So I have to buy a certain amount of that to battle it. So if this is going down 5 grand, I kind of need this to come up 5,500, okay? It keeps me kind of in line. But you don't have to just do SQQQ. You buy SDOW. So if the Dow is coming down, now you're making money there. So you have two. Then you buy TZA, which is like the Russell small cap. I always have that one now. And you buy, what did I say? Oh, SPXS and SPXU. They're both the SPY, shorting the SPY. The thing is that SPXS is a triple leverage, and I prefer the triple leverages myself. I'm very comfortable with trading and leverage and margin and triple leverages and putting my foot on the gas directionally heavy. I'm very comfortable with that, but I've been doing this a long time. So these types of tactics they're relatively advanced, and you might want to be kind of careful. But typically, if you just had 1,000 shares as an example of, some longs over here, and you managed to maybe get yourself like 200 of the SDOW, 200 of the SQQQ, 200 of the SPXS, and 200 of the TZA, and then you could throw in a bonus one. Like right now, I want to tell you straight up, they're coming for the real estate market. They have to lower the values and cool off the real estate market to lower inflation. Same way that they're crashing the stock market. And historically, the stock market goes, and then after 6 months starts the real estate decline. And if you read the reports, it is inflecting. So that is starting. It also has been 6 months. Everything is making sense. And the Fed, 3 of them came out and said they do need to cool it down in the real estate market. So, and that's another way that they keep you kind of broke, so that you either panic sell and lose your money in the stock market, or you can't access your money because it's down so much at a loss. And so this is a tactic for them to lower inflation. It also, raising the rates really fast is a tactic to lower. Right now, mortgage applications are down 75% and mortgage originations are down 58%. That is completely because they're tightening with the interest rate. But let me tell you something. The interest rate tightening is not slowing inflation enough. It's not decreasing the rate. It was at 8.5. It came in, at 8.2? I think that the estimate was 8.1. Okay, it decreased a little bit, but you have base effects, and we had a problem with the core inflation, and core is hella sticky. Okay, so the market didn't like it, and neither did I, quite frankly. And those rate hikes, the 1/4 point and the 1/2 point that they did, they're not slowing inflation. But look, newsflash, they printed a lot of money, and it took a lot of time for us to get this high on inflation. So they lowered the rates, printed a ton of money. We didn't have ultra inflation on month 1. It took a long time. It took all the way through 2020, through 2021 into it was like spring, summer of 2021, we started really talking about rate hikes and what they're going to do. Inflation was starting to surge, and we were kind of going through that curve, and now it got to a top part, and it might be inflecting. We might be peaking. We probably are in the zone of the high side. We're either right over at the top, we're at the top, or we're just about to come down from the top, but we're on the top side. Okay, so the half points aren't going to really lower it for a while because there's a lag time on that, at least 6 months. Okay, so they've done 2 of them for 2 months, so you're not going to even feel that for at least a few months up the road. And because of that, they're going to continue to raise rates, which means the media is going to be upset, which means that the market will still decline, which means the technicals that are showing are accurate, which means this video is super important because it is a way to be defensive, to hedge, to de-risk, to consolidate, to spot tops, to use an indicator to get out, and to just save your butt, because these are stressful times. I'm not as stressed about the stock market because I'm good at it, but I am very stressed about the real estate market. To the point, I'm actually thinking about selling my estate, taking all the cash, which is a lot, and renting at a high price for a while till the bottom of the market comes, and then scoop up several homes, a really nice, estate again for myself and family, and then multiple rentals. I'll fix them up. I used to be a developer. I've done fix and flips. I love real estate. I understand real estate really well. Real estate and stocks are like my favorite. I don't want to get too into it, but I had a branch. We had 1,500 branches across the country. I owned 3 of them. We had our CFL license, our CRMLA, which is a banking license. We used to sell $40 million in mini bulk on the secondary. I don't want to get too into it. I also built a lot of homes. I was a developer, so I love real estate. Love it, and I love stocks. And it is so hard to sit here in, nearly a $3 million estate on the water, which is my dream home, and I put a lot of money, of my own money, into the home, and it's gone up 800 to 850 grand in 2 years. So I would be able to get that plus the other minus the closing costs, which would probably be like 125, 140 grand. It's probably going to cost a lot to sell it, but you can get a really good team, a 14-person team. You really do it up, and you move this sucker at the top. Unless your ego gets in the way. And for me, I love this home. I will probably never find a home exactly like this. This is a one-of-a-kind, unique home. I love it. But logically, if I could take, close to a couple million cash in a bear market and rent for a year and just pay the dude, let's say he wants to overcharge by $800, I'll say, no. How about you just lower that down to what it should be, and I'll just pay you up front for a whole year. Now I'm cool. I'm chilling. I got a spot, and I lose my house, but I got a lot more cash on top of the cash I already have, and I'm ready to buy the bottom of the housing market as well as the bottom of the stock market. And you do that in cycles, decade over decade. And by the time I'm 60, maybe I have 20 more properties and a lot of passive income coming in. And when you're older, you just want to piece off a house or two. I need 800, 700 grand, $1 million, whatever the houses are worth. Boom, sell that one, sell that one, sell that one. My daughter's getting wedding. Oh, I got to go at this. And want to go to Hawaii, buy a car. Want to go to France. I'm going to move to France. Whatever. Let's knock off a couple houses. They're paid off. Why? Because you made a good decision. Now you bought at the bottom end of the market, and you got somebody else you got a good rate and a good mortgage, and you got somebody else to pay your mortgage for you. Okay, you put yourself in a 30-year, 15-year fixed, and you get somebody in there, and you charge them, very close to what, hopefully on the upside, but even if it's on the downside, and you got to pay a couple $100 a month for your home, and then the maintenance, of course, but it's worth it, okay? Because over the years, you're investing in yourself, and when you want to cash in on some of that, you can. But, they're going to lower the rates, and I know that for a fact because the reason they raise the rates is to slow inflation and protect the world reserve currency, the US dollar, which is shooting the moon, by the way. Like I had said back in November, it would. And you know, stocks and crypto are not going to go up very big until the dollar kind of comes down. And that's just the way it works. So yeah, I'm really thinking of selling the house. Super sad about it, but logical, very smart, very logical. Because here's the thing: the housing decline is going to be 30% to 50%. Okay, the report just came out. Out of all the cities that they did the report on, 149 of them are overpriced by at least 25%. Arizona, Idaho, California, there's different ones. I'm in California in the water. So I'm thinking California is always so extreme in everything. And in the financial crisis, it was 50%. So between 30 and 50, I'm just going to say 40. Well, 40 for me is like close to 1.3, 1.4 million in losses. So if I can't trade as aggressive in a bear market making as much money, and I'm also going to lose 1.3 million of my net worth in equity, wouldn't it just make sense to sell at the top like I'm teaching you in this video and also do it in the real estate? Buy low, sell high. I mean, I made 850K. I'm going to get all my money I put in there too. And the only thing that really trips me out about selling the house is I'd hate to sell at the top and then buy another house at the top, because I really want to do a 1031 exchange. I mean, that's what you want to do from owner-occ to owner-occ, and you got to do that. But dude, these houses are like, I'm not going to get no matter what, it's going to be a downgrade in my life, a huge downgrade, no matter what. But dude, that's ego. Like, this is wealth building. Wealth building, sometimes you got to sleep on the couch, and you got to just, you know, roll up your sleeves, and you just got to bite the bullet, you know. I know everybody will be bummed because people like coming to my house because it's like a resort, you know. It's massive, and it's like people just love to come over here and hang out at the lake and go out on the boat, and you know, it's like vacation for them. But you know, if I got 20,000 in bills and the market comes down, I lose 1.3 million in net worth on the equity of the home, and then let's say that takes 5 years to get to, you know, about where we're at now, and maybe 7 years. Well, 20 grand times 12 times 7 is $1,680,000. So I got to actually pony up almost 1.7 million in just living expenses in a bear market and lose 1.3 million in equity. Or I could stay here and just be ego. I mean, logically, it makes sense to just sell and just go rent something and then buy a bunch at the market. And then one of these nice houses on the water, these, you know, multi $3-4 million homes, they might be down at, you know, a $4 million home might be something at like, I don't know, maybe I get lucky at like a 2.5, or maybe I get a 3 million and the 3 million's worth, you know, maybe 1.7, you know, like, and then boom, you take the whole cycle and you rock it again and you sell again at the top and you get rid of ego and you just do that. And then each time you buy the bottom, you get more houses and you're just building wealth, basically. So that's on my mind. It's on my mind heavy. I believe with all my heart and all my experience, and I know a lot about real estate. Again, I was a developer. I had 1,500 branches across the country. I had every license known to man. I know real estate very well. I love it very much. And I made a lot of money in real estate. I don't know if you guys have known that, but real estate is like the way, and buying those bottoms in real estate is the best. But you also want to, like, you know, get rid of them like at the top, and it may go up a little more. Like, okay, so my house, it went up $139,000 in April, another $139,000 in April. Okay, now from my understanding, it might still go up a little bit more, but it's going to decelerate its growth, and we're pretty close to a top and inflecting. So if I were to list my home, and it, you know, you're going to need like a doctor or a brain surgeon or somebody to buy my home, like somebody with money, right? So you're definitely going to need somebody that has money to buy a home like this, and sometimes that either happens really fast, depending on how it's shown and marketed and negotiated, but it could take a while, and let's say it takes 6 months. Okay, that's a long time, I would think. 6 months. It might go up for a couple more months, not 139,000 a month. It might go up 100 grand next month. I doubt it. But let's say it goes up another, 10 grand for a couple months each, and then it's like the same, and then it starts going down for those last months. Well, I want to list it while it's still going up or before it starts going down. I mean, it's a hard decision, but it needs to be made quickly, and you can't hesitate on selling at top when you see a top. And I see a top in real estate, and I saw a top in the indexes, and here we are. And I'm trying to help you guys for the future here, because this is very, very important for wealth building, is understanding this stuff. Okay. Number 8 is get to at least 70% cash. You're going to need this to buy the bottoms and control your hedges directionally to keep your ROE in line. We kind of talked about that earlier, but that's actually one of the rules. Okay, number 9, use common sense, okay? Examples. You see the administration spending money. You see the Fed hawkish. You see inflation not coming down with rate hikes. You hear them talking about needing to cool down the housing market, maybe crash it. You know it's catalyst driven and driven by uncertainty. So why would you be buying longs right now in an overall downtrend, fighting the Fed, fighting the tide, and fighting the sentiment? You don't do that right now. You buy to come down to hedge, or if you don't have longs, you're killing it. You're killing it and you're making a lot of money. I have 4 longs and I have a lot more of the hedge ones, which is it's like 8. So I'm like 2 to 1. I'm 2 to 1 short. Net short is what they would call that. But I'm actually not shorting. I'm shorting a little bit, but what I'm doing is I'm doing inverse. And so I'm buying to go long, and it'll go up as the indexes go down. LABD, it's a really good one. My favorite little sleeper right now that I could tell the smart money is getting in on, I'm already in on it and up a lot, close to 10 grand. It's called DRV. Okay, it is betting that the real estate market's going to come down, and I can tell the accumulation that's going on that one is like I saw on coal and energy 6 months before anybody knew about it. So that's a really good little tip there for you. So let's see if there's any more tips here. Yeah, don't fight the trend. And look, like the whole thing is about wealth preservation. Okay, it's what it's all about. So I'll go through them really fast again. Number 1, use the MACD to know when the index is coming out. And then look at the stocks that are under that index to see if you need to get out. But no, you most likely do, because all tides will sink boats, all red tides, and the index is the tide, okay? That's number 1. Number 2, exit all profitable positions immediately and realize the gains. Number 3, have a plan to de-risk and get out of margin completely and immediately. This is critical because if you have margin and it continues to go down, you are forced to take losses at the lows instead of earlier when your stop was supposed to hit or you made a decision to sell it. Number 4, wait for momentum to springboard out. The indexes have to be going up. It has to be a bullish day, and your particular stock needs to be showing a lot of strength on at least the hour down to the minute. And you're going to 2x, 3x, 4, 5, 6x into a smaller percentage into momentum, and you're going to skyrocket yourself out and de-risk it. Okay, you're going to de-risk, and you're going to work down by lowest percentage down the line. Okay, this isn't a bear market. This is not in like the bull market or when you're going up. This is a defensive video. Okay, this is how to mitigate risk quickly. Okay, so. Number 5, reduce your positions and consolidate down to as many, like a lot less positions. So when you make the decision, am I going to hold and wait for the bottom, which can be up to 2 years, or am I just going to get out and springboard? You make that decision, but if you're going to hold, Make sure the ones that you hold are very sound fundamentally. They're very big companies, not going to go bankrupt, and that you can stomach holding for a long, long time and watching it go down a lot, and that you'll be patient enough to buy the bottom. And you want to consolidate that into like 5 or less, okay? Maybe 3 or less. That's what I mean by consolidate, okay? All right, next is add the hedges to your portfolio. LABD, okay? That's you're betting healthcare sector is going to go down. SOXS, that you're betting semiconductors is going to go down. DRV, you're betting that real estate's going to go down. SQQQ, you're betting the Nasdaq's going to come down. SDOW, you're betting the Dow's going to come down. SPXS, you're betting the SPY is going to come down. Also SPXU for single leverage, betting the SPY is going to come down. If you want to bet against energy, you can do ERY. Yeah, you can do that. You can do TZA is a really good one. That's betting the small caps are going to go down. That thing's a moneymaker. TECS, TECS, and Webs. I love those two. And HIBS is another one. TECS, Webs, and HIBS. Those are really good inverse plays in a declining market as hedges or just to make money. Look, I hope you guys learned a lot from this video. These are really good rules that I use to help, mitigate, get myself out of trouble fast, have a plan, identify what's going on early. Never be an investor that bases everything on hopium. Oh, but tomorrow it could go up. You don't know that. It's been going down every single day. Like, for those that think it could go up, I mean, this thing, yeah, granted, I'll give you this. The bear market rallies can be gnarly. Like, they can run. In fact, here's the cool little historical fact. One time, and I'll have to figure out which one it was, one time in a bear market, there was a 15-week bull rally inside of the bear market. That's how deep this thing went down, that it came way down and it went for 15 weeks up here and butt its head on it. 15 weeks. There's a couple of them that went 7 weeks as well. So, yes, I mean, and then everybody thinks it's a bull run and it makes another lower high and everybody gets decimated. But now that you know the MACD and how to spot that, you shouldn't get decimated, right? You should be like cashing in on that directionally. So I'm going to leave it there. Thanks for watching to the end. My name is Chris, and welcome to the Wheelhouse.